Pakistan's power sector has long been caught in a vicious cycle, the dreaded circular debt. For years, it's drained in public finances, bankrupted power producers, and left ordinary citizens paying more for electricity they barely get. But this year, something big happened. A record-breaking Rs1.29 trillion banking transaction, a new repayment mechanism, and cautious hope that Pakistan may finally be breaking free from the cycle. I am Hassan Ahmed, and in this video, we are breaking down Nasir Jamal's Business and Finance article on what circular debt really is, what the new deal means, and whether this could finally be a turning point for Pakistan's power sector. So what exactly is circular debt? Think of it as a chain reaction. The government underpays subsidies, power distribution companies don't recover enough from consumers, power producers can't pay fuel suppliers, and suppliers start cutting back. Eventually, it all circles back. Unpaid bills grow, electricity gets more expensive, and outages become common. It's not just a one-time issue, it keeps repeating itself. In the past, governments have tried to fix it with price hikes or emergency bailouts. But these short-term measures never address the root causes: inefficiency, poor governance, and massive power theft. This time, though, the plan is different. Instead of clearing dues, the government and banks have agreed on structured financing deal. Out of the total 1.29 trillion rupees, 683 billion was debt already sitting on bank balance sheets, just stuck with no clear repayment plan. The rest, over 600 billion, is fresh syndicated financing from 18 banks across the country. And yes, some banks weren't thrilled about it. They had to accept lower interest rates, and many now hold what they call risky power sector debt. But in the end, they went along, because this is not just about recovering money, it's about unblocking the whole power sector. Here's how they plan to pay it back. Consumers already pay a debt service surcharge on their electricity bills around 3.23 rupees per unit. That money will now go straight to the banks instead of vanishing into the government's general pool. No new charges, no additional burden on the public. The repayment timeline depends on interest rates. The lower the interest rates, the faster the debt can be paid off. If all goes as planned, could be cleared in the next 4 to 6 years. But let's be clear, this is just the start. Paying off the debt doesn't solve the deeper issues in Pakistan's energy sector. Distribution companies still lose billions to theft, poor infrastructure, and unpaid bills. And even though Pakistan has nearly 46,000 megawatts of installed capacity, only about a third is actually being used on average. So while the stock of circular debt is being handled, the flow still needs to stop. The government is finally showing signs of moving it in that direction. It's ring-fencing funds, introducing digital tools to monitor losses, and reworking how subsidies are targeted. The aim is to support vulnerable consumers without disrupting the entire revenue cycle. These are good steps, but as experts keep warning, we have been here before. Back in 2013, the government cleared nearly 500 billion rupees circular debt. It started building up again almost immediately. The hope this time is that with clear repayment plans, banking discipline, and better governance, the cycle might finally break. If it works, not only will the power sector breathe easier, but banks could redirect their freed up capital into other parts of the economy, like small businesses, agriculture, and clean energy. But it won't happen automatically. As the head of the Pakistan's Banks Association, Zafar Masood puts it, this is just a breather. If reforms stall, if distribution losses continue, if privatization plans get shelved, we'll be right back where we started. Because circular debt isn't the disease, it's just the symptom of a power sector that's been broken for far too long.